So we're going to talk about that's kind of the first step of accounts receivable. Like, hey, what happens? How can we get money? We can get cash. We can get accounts receivable by invoicing customers, or we can use credit cards, either our own credit cards or a bank credit card. That's how we get money into our bank accounts. That's what everyone wants to do. You want to put money in the bank, right? So the next step, though, is, okay, what happens if we can't collect? And this always happens. Many customers don't pay. Some customers have a strategy of not paying. I've had customers who try not to pay for months on end because that's just their strategy. Hint, I don't work with those customers anymore. Most of the time, they get a very bad reputation very quickly. I think that's some of the news, like, and not being political here, but that was the news related to Donald Trump, like his business dealings. His business had a strategy of deferring payments. And so you kind of make a bad reputation for your business for yourself, for the purchasers at that time, because you're not getting paid. But there's many businesses who take this strategy, albeit if it's ethical or not, I'll leave that up to people to decide. But what do we do to write off when we know we're not going to collect the money? So if I have a customer who hasn't paid me in 6 months, how do I account for that? So there's two methods. One method's, well, there's really multiple methods, but I'm going to go over two in a lot of detail. One's an easy way to do it, but it's not a correct from a GAAP perspective, and one's correct from a GAAP perspective, but it's much more complex. The not correct way, but the easy way, is the direct write-off method. So when we determine that a customer can't pay, which means like they sent us a letter or told us verbally, we're not going to pay you, or we haven't heard from them in a certain amount of years, we write off the account. That's the direct write-off method. The second method is the allowance method. The allowance method is more complex and has to be used for GAAP accounting because the direct write-off method violates accrual-based accounting. If you think about it, if I only write off an issue as soon as I'm 100% aware that a customer owes the money, isn't going to pay, I'm violating the revenue recognition principle, where I'm not recognizing revenue when they're earned and expenses when they create their revenue, because I should be doing that up front. There's a certain amount of revenue I know I'm not going to ever collect. So I should be making that estimate up front. That's the allowance method of how do we determine that estimate up front. So direct write-off and writing off bad debts. So at the end of this period, I mean, this is the simplest one, the direct write-off method. At the end of a period, we say, you know what, this customer, Jay Kent, we haven't heard from him. I think he fled the state. We just aren't going to bother him anymore. So we debit our bad debt expense and we credit the accounts receivable. We take it off our books. So we increase our bad debt expense and we reduce the accounts receivable. How does this affect us? It decreases our net income, right? This is not good for us on income statement, and it decreases our assets. Note that we choose a specific customer, right? We want to make sure that we go after this customer. This is why this job is important. If you have someone who's not detail oriented or lazy, what if they write off the wrong account? Uh-oh, you need to stop collecting money from somebody. So it's important for someone very detail oriented to be involved in this job. But then, you know what, we wrote off the account, but then Jay Kent comes back and says, hey, I feel really bad. I actually came into some money. I want to pay you guys back. Oh, sorry, there's a question. Let me open it up. Yeah, so someone's asked, would you file a case for them? You could. I'm not going to go over that in this. This isn't like a debt collections class, but there's other ways to remediate debt. You could sell your account receivable to a debt collection agency. You could hit their credit score and all that fun stuff. But I'm not going to go over that in this class. That's a different class. This is more about the accounting and consequences. And most of the time when you go down that route, people don't pay anyways. Yeah. On March 11th, Jay Kent was able to make full payment to TechCom for the amount previously written off. So sometimes you write off a customer and then they come back and say, hey, think about it this way. I do great consulting services for somebody and then they don't want to talk to me afterwards. They don't pay me. And I'm like, okay, I don't want to work with that guy again. And then he realizes, hey, Devin made me a bunch of money. I should call him again. But he's pretty mad at me for not paying. So I'll make sure I pay him first. This happens. It's happened to me. It happens to customers all the time where customers realize they need a service and so they go back and pay their old bills.
Professor, yeah. Sorry about that. Like in that case, would you take that person back, or?
That's a judgment call. Yeah, I mean, at the end of the day, I personally normally don't work with people again if they are late on payment, but most companies will work with. Like, money's money, right? If, as long as it's a reasonable customer, that maybe just won't give them credit again. Maybe they'll say, hey, you have to pay up front, or they'll tighten the credit terms.
Thank you.
No, good question. So it's kind of like a bad boyfriend or girlfriend, right? Like, yeah, do you take them back if they've apologized? I'm not sure. It's really it's up to you. But normally I think it's best to look at past behavior. So in this case, we'd have to adjust the books. At the end of the day, we're accountants. We don't judge what the customer does. We just document how the transactions occurred. So in this case, we would have to add back the accounts receivable. We'd have to reverse the prior entry. So we debit accounts receivable and credit bad debts expense. That's the opposite, right? We just flip the entry. So we're reestablishing the accounts receivable. And then we do a normal collection of cash where we debit cash and then credit the accounts receivable. So we just reestablish the accounts receivable so we can remove the bad debt expense, and then we reestablish the cash. And so this is just what I said before, matching versus materiality. The direct write-off method violates the matching principle because our expenses don't match revenue recognition under it. But generally, if a business doesn't have a lot of bad debt expense, or if you don't have a lot of accounts receivable, it's okay to use a direct write-off method if it's not that large, because it'd be immaterial. But if you have a lot of accounts receivable, you have to use the allowance method. And so here's our journal entries. Here's another example. We'll go through it quick. Retailer determines it cannot collect some $400. What do? We increase our bad debt expense, debit it $400, credit the accounts receivable $400. And then they come back and pay their account in full because they want our stuff again. So we debit our accounts receivable, we reestablish the accounts receivable. This is just a flip. And then we collect the cash. Debit cash, credit accounts receivable. Any questions on this?
So what statement does the bad debt expense show up? Is it the income statement?
Correct. All revenue and expenses show up on the income statement. Good question.
I had a question about when you're talking about the when write-offs are okay. So is that based on value or number of accounts receivable?
What do you mean? What's your question?
So earlier on the previous slide, when you're talking about when a write-off is considered okay, you mentioned that if the accounts or if the amount was large enough or something, then you need to use the allowance method. Whereas, yeah,
I got you. So it's the direct write-off method. So there's two methods. There's an allowance method and then the write-off method. The write-off method is wrong. Theoretically, it's a wrong way of doing accounting because it's not following the matching principle. We're not doing accrual-based accounting with it. We're waiting too long. We should theoretically be matching the expenses with revenues, right?
Yeah.
On the same page there. But if a company has very low accounts receivable, they might still do the wrong way because it's immaterial. Because it's such a small amount, they don't want to waste their time doing the allowance method. That's still okay. That's why accounting is complex, right? We use judgment. Like, oh, maybe it makes more sense to use the allowance method. Like, that's the correct way. But if a company's what if a company only uses 1.1% of their business as accounts receivable? Well, they can use the direct write-off method. No one's going to care, right? We use our judgment. And so you as an accountant will develop that judgment and apply these theories to companies, determine when it's appropriate to use which method.
Okay.
Yeah. Good question.